Hi, this is part 2 of the creative accounting course, so let's go to see what actually is a balance sheet. A balance sheet is an overview of assets, liabilities, and these two can finally create equity. Let me explain. Assets can be concerned like belongings or possessions that you use in your company. And liabilities are more like debts in your company, money that you owe others. When you make this opening balance, you make an inventory of your company to see what assets and liabilities or debts you have in your business. And let's make an inventory of our example company from John. John starts his company with, let's say, a small van, and the van is paid in installments. The van is worth 6,000 euros at the moment the company starts. From this 6,000 euros, he still needs to pay 4,400 euros to his supplier, 4,400. Then he has a new computer with software who was private owned before, but he kind of bring it into his company at the start. The software and computer is worth for 1,500 euros. Then he has some money on the bank, 2,250 euros, and he has some cash money, 500. To make this all happen, he had to loan some money from his family, and this amount was 1,400, so he needs to repay that in time. If we divide these items from the inventory into assets and liabilities, we see that the assets are like the small van, the new computer, and the money in bank and cash. If we add all these assets together, we come to an amount of 10,250 euros. So this is the amount of assets within the company, and it's the asset side of the balance. Remaining are the debts. The debts are the money still needs to be paid to the supplier, and the loan he has to pay back to his family in time. If you add these two, we come to an amount of 5,800 euros. So these are the debts in the company of John. People that we still need to pay money to, especially the ones that we got goods for that we need to use, like the van. We call them creditors or accounts payable, and we'll see this coming back in the balance sheet later on. Debts in Dutch is called schulden, or with more bookkeeping term, vreemd vermogen, which means strange liabilities. If we have these assets and these liabilities, we can calculate the equity of the firm. It's the difference between the assets and the liabilities. If we subtract the liabilities from the assets, the remaining is the equity. So in this example, the assets of 10,250 minus the liabilities, the debts, 5,800 makes 4,450 equity. So it means the equity is like the amount of money that this company is worth for you. If you sell all the assets, if you pay off all your debts, what's left over is yours. Naturally, it's only on paper. In Dutch, equity is called eigen vermogen, which means your own investments in your own company. And this is like the opposite of vreemd vermogen I told you before, which is like the debts that you have to pay to other people. So we have equity, which is a debt on your own, and it's debts or vreemd vermogen, which is like debts to other people. Together they form the liabilities side of your balance sheet. So we have an asset side and we have a liability side. And it's gonna look like this. This is the opening balance of 1st of January 2020. In this case, the assets on the left side and the liabilities on the right side. The assets are divided in fixed assets, like the van and a computer system. These are things that kind of last longer than maybe like a year. So these are called investments. We come back to that later. And the other part within the assets are the current assets, like bank and cash, and we'll add some more to this later on in this course. The right side is the liability side. In Dutch we call it passiva. It's the equity we just calculated, and it's the debts. In this example we have divided in two parts: long-term debts and short-term debts. The accounts payable, so are the creditors, are the suppliers that gave us already goods, but we haven't paid them yet. So we still need to, and that means we have a debt to them. You see that the totals of the assets and the liabilities are equal, and this is always the case. That's why it's called a balance. If something is like changing, then the equity will always be changed, so the balance will be restored at any time. So it's like it cannot be not in balance. It's like always in balance. Good. That's about the opening balance and the balance sheet. We learned that we have assets on the left side, we have liabilities on the right side, and the liabilities contain of equity and debts. So the assets minus the debts will result in the equity. Let's continue to part 3, where we can cover the sales. See you there.